Welcome to Talk Tickers, where your deep dive into the corporate calls that really matter.
And today we are definitely diving deep.
Yes, we're tearing into the Levi Strauss Co earnings for Q3 fiscal 2025. That call happened October 9th, right after market close.
And it's a fascinating one because, well, there's this huge disconnect, isn't there?
Totally. What do you mean exactly?
Well, operationally, Levi's, they delivered what you'd call a textbook beat and raise. I mean, solid results, raised outlook.
Showing real structural strength, clear strategy playing out.
Exactly. Financially, they beat expectations pretty handily, but then the market reaction.
Oof. Yeah, the stock took a massive hit, down what, over 12%?
12.6% drop. So you have great results, good outlook on the full year, and bam, stock gets hammered.
That's the puzzle we need to unpack for you today. Why the disconnect? The stock clearly reacted to the outlook, but the quarter itself, that was solid.
Very solid. Let's start there. What were those headline numbers?
Okay, so adjusted EPS, that came in at $0.34.
Right. Beating the $1.31 consensus. A nice beat on the bottom line.
And revenue, $1.54 billion. Also beating the estimate, which was $1.5 billion.
And importantly, that's 7% year-over-year growth, both reported and organic.
Yeah, that organic piece is key. Shows it's not just acquisitions or currency tricks. It's the core business growing.
Definitely. And then there's the margin story.
Which often tells you more about the underlying health.
Absolutely.
Really.
Gross margin expanded by a healthy 110 basis points year over year.
Wow, 110 BPs. So where did that land them?
61.7% gross margin. Getting margins up like that, especially now in this environment, it tells you their strategy is clicking.
Uh-huh. Anything else on the snapshot? Liquidity.
Yeah, they finished the quarter strong there too. $613 million in cash. Total liquidity around $1.5 billion. So plenty of cushion.
Okay, strong quarter financially. And they backed it up with guidance.
They did. They actually raised the full year outlook. That's important.
Right. So what's the new expectation?
They're now expecting full year revenue growth of approximately 3%. That's up from the 1% to 2% they guided before.
Okay, so higher sales growth for the year.
And they tightened and raised the adjusted EPS range too. Now looking for $1.27 to $1.32 for the full year.
So if you just stop right there, everything looks pretty rosy. BQ3 raised the full year.
Exactly. Purely based on Q3 and the full year raise, you'd expect a positive reaction, which is why we need to dig into how they got these Q3 results.
All right, let's get into the structure. What's driving this outperformance?
It really comes down to that strategic shift they've been talking about for a while. The direct-to-consumer first strategy, it's paying off big time.
DTC, how much growth are we seeing there?
DTC revenue grew 11% year over year, and it's now 46% of their total sales. That's almost half the business.
46%. That's a significant shift from their traditional wholesale routes.
Huge. And within DTC, e-commerce was even stronger, up 18%.
And the key with DTC, for listeners maybe not tracking retail day-to-day, is the profitability, isn't it?
That's the core advantage. It's about control. They specifically called out that their DTC initiatives drove over 400 basis points of margin expansion just in that channel.
400 basis points?
Yeah.
Just from DTC improvement?
Yep. Because they control the price. They sell closer to full price, fewer markdowns compared to selling through wholesale partners.
The mix shift, more sales, moving from lower margin wholesale to higher margin DTC, that's a big driver of the overall margin lift we saw.
It was the single biggest driver of that 110 BPs expansion, yes. That plus some targeted pricing actions and just selling more stuff at full price.
And you mentioned earlier, they did this while facing headwinds.
Right. This is a really important point. That 110 basis point gain happened even while they absorbed an 80 basis point hit from tariffs in Q3.
So they overcame that drag.
They more than offset it, which speaks volumes, I think, about the brand's pricing power right now, and also the benefit they're getting from shifting towards international and women's categories, which tend to have better margins.
Okay, let's touch on international then. How significant was that?
Very. About 3/4, 75% of the total growth came from outside the Americas.
75%. Where was it strongest?
Asia was the real standout. Growth accelerated there to 12%. But the Americas still grew 6%. Europe grew 5%. So pretty broad-based strength globally.
Feels like the brand refresh is working across markets.
Seems like it. And they're also sharpening their focus.
You mean the Dockers divestiture?
Exactly. They completed the sale of the Dockers U.S. and Canada IP and operations. brought in about $194.7 million in gross proceeds.
Which isn't just cash in the bank, right? It's strategic.
Absolutely. It lets them focus everything capital, management time, marketing dollars on the core Levi's brand and where they see the best growth and margins.
And that confidence seems reflected in how they're using their cash, the capital allocation.
You mean the buybacks? Yeah, that's a huge signal.
How much did they return to shareholders?
$151 million just in Q3. And the big piece of that was a $120 million accelerated share repurchase, an ASR.
An ASR, for those listening, that means they're buying back stock quickly, right? Like they think it's cheap now.
Precisely. It's a strong bet on themselves. Management is basically shouting, we think our stock is undervalued based on the structural improvements we're making. They're using cash to retire shares immediately. Huge conviction signal.
Okay. Which makes the market reaction even more, well, puzzling. You've got a beat, a raise, structural improvements firing, and aggressive buybacks.
And still, the stock gets crushed.
So we have to pivot. Let's talk about Q4 guidance. This is clearly what spooked the market.
This is the crux of it. Despite raising the full year, the Q4 guidance came in light. Expected adjusted EPS of $8.36 to 38 cents.
And the street was looking for.
Consensus was $0.41, so significantly below.
And investors immediately assumed this meant demand was falling off a cliff.
That seems to be the interpretation, yes. Panic selling.
But did management say demand was weakening?
No, quite the opposite. They were actually pretty explicit. They said they were not seeing any material change in global demand trends. They even noted sales growth was coming from unit volume, not just price increases.
Okay, so if demand is holding up, why the lower profit forecast for Q4 specifically? What gives?
It boils down to timing and policy, specifically tariffs, and a conscious supply chain decision.
Okay, explain that. Tariffs hit cost of goods sold, obviously.
Right. And the revised outlook baked in much higher tariff rates. We're talking 30% on goods from China, about 20% for the rest of the world, impacting Q4. That's a direct hit.
But why such a concentrated hit in Q4? Were tariffs suddenly hiked just for that quarter?
Not exactly. It's because of when they bought the inventory. Management made a tactical choice. They pulled forward a lot of their holiday inventory.
Pulled it forward, meaning bought it earlier than usual.
Yes. About 70% of their key holiday stock. They did it deliberately.
Why? To avoid potential shortages.
That, and to mitigate the risk around tariffs. Basically, secure the goods for the crucial holiday selling season. But that inventory, bought under those higher tariff regimes, well, the cost hits the books now in Q4.
Okay, so they prioritized having the product on shelves for Christmas, even if it meant Q4 margins looked worse because of those tariff-impacted costs flowing through.
Exactly. They chose certainty of supply over optimizing the Q4 P&L number. They even quantified it. They expect Q4 gross margin to contract by about 100 basis points.
Contract. After expanding 110 BPs in Q3.
Yes. And they said 80 basis points of that 100 BPs contraction is purely due to the tariff headwind from this inventory pull forward.
So most of the Q4 margin pressure is this timing issue with tariffs on early bought inventory.
Yeah.
It's not necessarily a sign the underlying business profitability is collapsing.
That's the argument, yes. It's a temporary distortion, not a fundamental demand problem. They protected the holiday sales period by taking the market hit now.
That context is absolutely crucial for understanding the guidance miss. Okay, before we move to the trade idea, let's quickly touch on a broader strategy again, this head-to-toe denim lifestyle push. How's that progressing?
It's moving along. I mean, it's tough changing perception when you're known for jeans, right?
Sure, the iconic 501s.
But the TOPS business, their shirts and jackets and so on, it grew 9% in Q3. Still mostly bottoms. The ratio is about 3-to-1, but they're gaining traction.
Any specific areas doing well?
They mentioned men's woven button-downs grew 20%, so progress. And they're doing this while also trying to be more efficient.
How so?
Reducing complexity. They cut the number of SKUs, the individual products, by about 15% year over year.
Fewer products, but growing tops.
Yeah, while also increasing the globally common assortment stuff they sell everywhere to 40% of SKUs. So fewer unique items overall, but more core items available globally. Streamlining.
Which should help margins and inventory management long term.
Absolutely. It all feeds into that bigger goal they keep talking about.
The 15% EBIT margin target.
Exactly. The DTC push, the Dockers sale, the SIU rationalization, it's all designed to build towards a sustained 15% operating margin.
Which, as you said, the market seems to be ignoring right now, focusing just on the Q4 noise.
Which makes this a perfect setup for our final segment.
Indeed it does. All right, folks, buckle up.
This is not financial advice.
Go ahead. What's the outrageous but plausible trade idea here?
Okay, here's the pitch. The market completely misread the situation. That 12.6% sell-off, pure overreaction. It was based on Q4 margin pressure that's frankly temporary.
Driven by the tariff timing, and also we should mention lapping the 53rd week from last year, which adds noise.
Right, exactly. So transient factors. Investors panicked and completely missed the bigger picture. The structural shift to a higher margin DTC-led platform is not only intact, it's accelerating.
So the thesis is, market focused on the blip, missed the trend. What's the actual trade?
You go long LEVI, tactically long. The company basically reconfirmed all the pieces are in place to hit that 15% EBIT margin target eventually. They talked about 200 BPs of gross margin upside and 200 BPs of SG&A leverage over time. That potential isn't reflected in the price right now because of this tariff confusion.
Okay, long LEVI, but how do you structure it? Is there a pair?
Yes. You make it an asymmetric bet on their channel advantage. Pair the long LEVI with a short position against a competitor. Specifically, pick an apparel peer that's still heavily reliant on traditional wholesale distribution.
Why wholesale?
Because in this environment where consumers are maybe getting a bit more value-focused and where wholesale partners are dealing with their own inventory issues, those traditional players are likely to face sustained pressure. Much more than Levi's with its strong DTC engine.
So you're isolating Levi's strength, the DTC channel and brand execution, against a weaker wholesale model, betting that Levi's structural advantage will overcome these temporary policy shocks much faster.
Precisely. It's a bet that this Q4 tariff thing is just a blip, and the real structurally higher profitability story comes back into focus quickly, say, early next year in 2026. The market's short-sightedness is the opportunity.
Very clear. A sharp thesis exploiting that divergence between the strong Q3 and the noisy Q4 outlook. So to recap, we saw a powerful beat and raise quarter from Levi's.
Driven by that DTC-first strategy really firing.
But the stock reacted negatively because the immediate Q4 forecast looked messy due to those tariff costs being pulled forward.
Yeah, optically messy, but arguably strategically sound to protect the holidays. And management is backing their strategy with that big ASR and a dividend increase. They're putting their money where their mouth is.
Which leads us to the final thought for you, the listener. Management is clearly signaling confidence with buybacks and dividends. So, do you buy their story? Is this Q4 tariff impact just a short-term headache, a blip that fades as inventory normalizes? Or is the market right to be worried, pricing in potentially persistent policy risks and uncertainty around costs going forward into 2026?
And of course, the necessary disclaimer. This was purely for informational purposes. Based on a read of the earnings call, it is absolutely not financial advice.
Please do your own research before making any investment decisions.
Definitely.
Excellent. Great discussion. We hope you found this deep dive valuable, and we'll see you back here next time on Talk Tickers.